Hi everyone, welcome back to the Property Finance Podcast, and today is probably the most controversial episode that I'm ever going to do. So this is not about going viral, this is not about trying to create controversy, this is purely about trying to educate people that there are sharks out there, and there are some really smart lenders, some really great lenders out there as well. So this episode is talking all around how you can avoid the sharks that are out there in the bridging world and how to kind of pick out red flags and things like that. So one of the first things I want to talk about, and this is definitely going to raise some eyebrows and probably cause a bit of trouble, but there we go. We like to live on the edge. The first one is talking about how there are some bridging lenders out there. And my first disclaimer is there are way more good bridging lenders out there than there are bad. So any bridging lenders listening to this, please do not take this as being aimed at you, unless you do this stuff, in which case this is fucking aimed straight at you. There are some bridging lenders out there that only make money when you go into default. And there are some bridging lenders out there who will actively try and push you into default so that they can charge horrific default fees, horrific default interest, and essentially push you into receivership, which then ramps up all the fees, the interest, everything else, and basically try and monetize it as much as possible. There are lenders who will do that. What that looks like in practice is, and this tends to happen if you use a bad broker or if you go to lenders directly. Because if you go to a lender directly, who maybe you found on a Google search or something like that, or maybe they're a bit more of a private lender, you've met them at a networking event or something like that, you don't really know much about them. They can be the predatory side of bridging finance, which is preying on first-time investors, people who maybe don't have as much knowledge in the bridging space, and they can put these default fees in. So what they'll do is they'll sort of say to you, you'll maybe go to them and say, well, I only need 6 months really to do this project. Now, that to any bridging lender is an immediate red flag. What do you mean you only need 6 months? Because no matter what you're doing, whether it's a small refurb, whether it's a commercial conversion, development, whatever, doesn't matter. Even if it's a quick tart up and flip, 6 months is not long enough. Because to be fair, you can eat that 6 months up just waiting for the land registry. You can eat that 6 months up just waiting for the refinance. So any good bridging lender immediately would look at that and go, there is no way we are lending to you for only 6 months, minimum 9 to 12 months. That's all we're going to be interested in. That is a sign of a good bridging lender. A bad bridging lender will see 6 months and go, yeah, absolutely. Yeah, we'll lend to you straight away on 6 months. Yep, no problem whatsoever. We love that. We love that you're going to get out of that as quickly as possible. We love that you're only taking 6 months. That's great. Oh, but by the way, we're going to charge a 5% default fee, and we're going to charge you 2.5% a month, 3% a month if you run over. So if you run over, it's 5%. Oh, and by the way, we don't really offer extensions. So the second you go over that 6 months, that 5% gets added to the loan. Oh, and by the way, we may even look at, with the default interest, if you go into default, we might actually backdate that as well to the start of the loan. There are bridging lenders who do this, by the way. So this isn't just me making stuff up. Like, genuinely, there are bridging lenders who we've seen the terms from that say the second you go into default, they will backdate it to the start of the loan term. Fucking insane. Like, to go from 1% a month, you've got that in your mind, you've calculated that for 6 months, everything else, to then go, oh, by the way, actually that 2.5% actually goes all the way back. So actually you've got 6 months at 2.5%, plus then the 5%, plus then you're on 2.5% moving forward as well. Plus also we're going to put you in receivership the day after it goes as well. So we'll literally send someone round the day after it goes. We'll send bailiffs round, start the court process, everything else. They are the really, really predatory processes that some bridging lenders will do. So that's the immediate first red flag, is if they'll let you take only 6 months, because that's just bonkers for them to say that. If they don't offer extensions, if they have huge default fees, that is immediately, I would run a mile from that. Any default fee that is over a couple of percent, I would run away from. And also, you need to be able to get an extension. And I get lenders need to charge for extensions, everything else, that's fine. This is a bit different. So if someone comes, if you're doing a 6 month term, and at the point of 4 or 5 months, you go and say, oh, by the way, can I have another 6 months? and they say, yeah, of course, but it'll be a 2% fee, but we'll carry the same interest rate on. Great. That's actually a good practice. Like, I like that. I like that a lender would offer an extension with a fee, but at the same terms as what they were doing. That, I think, is a good practice. If they're getting into that thing of, no, we don't offer extensions or anything like that, we're just going to put you straight to default, backdate it, everything else, horrendous fees and everything else, I would just run a mile. So that is one of the worst practices. And the reason why these bridging lenders do that is because what will happen is they will go and get their funding from someone else. And so essentially they just become a broker for that funding line is kind of all that happens. So they'll have a funding line at, say, 11% per annum, let's say, just for argument's sake. So what they'll do is they'll take the money in at whatever the percentage is, 10, 11%, whatever, and then they'll pump it out at 12, 13%. So they're making a small margin on that interest. However, that really isn't making them any money. If it's only a couple $100,000 loan, I mean, let's say it's a £200,000 loan, and they're making 2% on that, it's £4,000. I mean, that over the lifetime of a 6-month loan, it really doesn't make a lot of money. It barely pays for the staff who are in the office. So that is why they then have to put on horrific default fees at 5%, because if all of a sudden you got a 5% default fee, well, that's 10 grand. That's another 10 grand that they've made on that deal. If they're then going to default interest at 2.5%, you know for a fact they're still only paying 10, 11% on this money. But all of a sudden, rather than making 2% per annum, they're now making nearly 2% per month on that deal. So all of their return is coming on you going into default. So you have to just be really, really wary of that. And like I said, good brokers, good lenders, they don't get involved in any of this stuff. Good brokers would never put you with a lender that, one, accepts 6-month terms or short terms like that, doesn't offer extensions, and has default interest rates like that and default fees like that. Simple as. When you get onto the good side, so this is talking about, so more the sort of smart finance, if you like. So good lenders, they will offer extensions. They won't have ridiculous default fees. And don't get me wrong, a default fee is a good thing to have. It keeps everyone accountable. But not offering extensions and forcing people into default interest rates and fees is a bad practice and shouldn't exist in this industry. It just shouldn't. By not having those, or having a smaller level, that's where the good lenders come in, offering extensions, X, Y, Z, being really clear about their terms as well. Because back end of 2024, I think it was, in early 2025, there was a huge scandal in the car financing industry, and commissions weren't disclosed, all this kind of thing. And you can read about it on the internet, and no doubt we'll probably do a podcast about it at some point. But because of that, it's forced the property industry to be more transparent with their fees. However, it hasn't become a necessity. So although certain lenders will come to us and they'll say, well, you have to be transparent with your fees, there are other lenders who won't be saying that to their brokers. Now, we are really, really clear with our fees. Always have been, always will be. We send out documentation when a case first starts, which has all of the documents laid out of, this is what we charge, this is when we charge it, this is how it's charged, this is where it's added to. Everything is really, really laid out. The lenders we work with also then send over term sheets that break everything down, really, really transparent about everything that they do. Nothing is hidden away. The bad lenders, that's where you get one-page documentation, isn't really massively clear about what they charge and when they charge it, and the clauses at the end, I mean, nobody reads them as much as anyone claims that they do. There are very few people who are going to sit there and on a 20-page document read every single word, because most of them will rely on their solicitors to do that. But again, depending on the solicitor that you use, your solicitor isn't always going to highlight that stuff to you. A solicitor isn't going to sit there and go, oh, by the way, are you aware that there are default fees? Are you aware that your default interest does this? Are you aware that if you run over the term, this is going to happen? Because realistically, they expect you to have that knowledge that actually you're not going to run over that time and you do know what you're doing. But the thing is, none of us can plan for those timescales. So that's where the good lenders come in. The green flags are really clear, detailed sets of terms, really clear fee structure, really clear about how they work with people, good social media presence as well. I know this sounds silly, but lenders with a good social media presence tend to operate more in the good space because they don't want the reputational risk of doing something that essentially someone can then call them out on social media for. So have to be aware of that as well. I mean, that isn't the gold standard. Just because they've got a social media presence doesn't mean that they absolutely are a good lender, but it certainly helps. And we find it with brokers as well. Brokers with good social media presence, again, tend to be the better brokers, only because they have that reputational risk of if something goes wrong, they get called out and the business pretty much closes overnight. That's one of the biggest worries I have in this industry, is that if I do something wrong, I get called out on social media, the podcast goes, the Instagram profile goes, the LinkedIn profile goes, because you can't recover from something like that. If I've put a client into something where they're getting charged a 5% default fee, a 2.5% default interest rate, and everything's just gone kaput, I'm never going to recover from that. So yeah, we need to make sure that we are only putting people with good lenders. So yeah, there's some of sort of the red flags and green flags that you need to be looking out for. I think the biggest thing I would say to people is listen back to previous episodes where we've kind of spoken about contingencies and a contingency of money, contingency of time, making sure that you take longer than you need, because this kind of finance, it is great to have in the toolbox. It really is. There is nothing like bridging finance in terms of how flexible it can be and everything else. But there is also nothing like bridging finance if things go wrong. I mean, it is the most aggressive form of finance for repossessions, insolvencies, XYZ. Like, they will come after everything because it's an unregulated industry. They will come after it. So it can be the best possible finance, it can be the worst possible finance. And it's just about choosing the right lender and understanding kind of these predatory practices and how to avoid them, and also these really good practices and how to make sure that you are working with those lenders who want to build up relationships and work with you moving forward. And also, when shit hits the fan, you want to know that you've got a lender who's got your back rather than a lender who's cheering at your failure. So yeah, hopefully that's been helpful. Like I said, quite a controversial episode, because undoubtedly when this goes out on LinkedIn and Instagram and social media, there will be lenders who ironically will take offense to this. But what I would say to those lenders who take offense to this is, if you are taking offense to this, you probably form part of the problem. And I think if you are looking at this as a bridging lender, listening to this episode now, and you take no offense whatsoever, you can probably be happy that your practices are good and that you are fitting into the best possible lenders. So yeah, and for those of you that are listening to this as investors and developers, hopefully that's just giving you a bit of an insight as to why, one, brokers are really good, but two, also why you really, really need to do your homework on who you're getting into bed with. So yeah, hopefully that's been helpful. If it has been, please like, share, do all that good stuff on social media. And otherwise, I'll catch you on the next one.